All right, let's settle one of the biggest debates in investing. It's passive ETFs versus active ETFs in a head-to-head showdown. This is a choice every single investor has to make, and honestly, the winner you pick for your portfolio could make a massive difference. So let's get right into it. Here's a simple way to think about it. Imagine you're on a journey. Do you trust the reliable, proven map that shows you the exact route, or do you hire an expert guide who claims to know a bunch of secret shortcuts? One follows a set path, the other promises a better, faster way. That's really the heart of the choice between passive and active investing.
So let's step into the ring and meet our two contenders. They represent two completely different philosophies on how to make money in the market. Let's see what really makes them tick.
First up, in this corner, we have the passive ETF. I kind of like to call this one the index hugger. Its entire job is super simple. Just copy a market index, like the S&P 500. It's not trying to be a hero, it's not trying to beat the market, it's designed to be the market, giving you pretty much the exact same performance.
So how does it do that? Well, the game plan couldn't be simpler. The fund just automatically buys and holds all the stocks in that index in the exact same percentages. Because of this, you get total transparency. You know exactly what you own all the time. And this hands-off approach, it makes them incredibly cheap and really tax efficient.
And in the other corner, we have the active ETF, aka the market beater. Now, this is our expert guide. Instead of just following the map, an active ETF has a real person, a portfolio manager at the wheel. Their whole job is to make smart buy and sell decisions based on their research and expertise. And the goal? It's ambitious, to outsmart everyone else and beat the market.
The strategy here is all about being nimble. The manager is constantly digging through research, hunting for opportunities, and tweaking their portfolio. That means the stocks inside the fund can change a lot, and it can look way different from a standard index. You're basically betting that their human brain can find those shortcuts to bigger profits.
Okay, we know who our contenders are. Now for the main event. We're going to break this down round by round, focusing on the things that really matter to you and your wallet. Let's do this. First up, round one, cost. You know that expert guide? They don't work for free. And this right here is one of the single biggest differences between these two ETFs. It has a huge, huge impact on your money over time. So, how big of a difference are we talking about?
Well, the expense ratio, that's the annual fee you pay, is night and day. Passive ETFs are dirt cheap. But for an active ETF, you're looking at fees that are often way, way higher. That extra cash pays for the manager's salary, their research team, all that frequent trading. It might seem like a small percentage, but trust me, over 20 or 30 years, that difference compounds into a breathtaking amount of your potential earnings.
And this chart just makes it crystal clear. You could easily be paying 5, 10, even 20 times more for active management. That higher fee creates a massive hurdle. The active manager has to beat the market by at least the size of their fee just to tie with their passive cousin. That's a really tough game to win year after year.
Which, leads us perfectly into round two, performance. This is the million-dollar question, right? Are you actually getting your money's worth? Does paying that market beater a higher fee actually lead to market-beating results?
The data here is, well, it's pretty overwhelming. Study after study shows the same thing. Once you factor in those higher costs, the vast majority of active managers just can't consistently beat their passive benchmarks over the long haul. Turns out that reliable old map usually gets you to your destination faster than the guide promising a secret shortcut. Okay, on to our final round. Round 3, strategy and transparency. This is all about knowing what you own and, well, knowing what's going on with your own money.
With a passive ETF, what you see is what you get. The holdings are public knowledge. It's simple. You always know exactly what you own. With an active ETF, though, you're kind of buying a bit of a mystery box. The manager is making moves behind the scenes, so you're really just putting your faith in their strategy, whatever that might be on any given day.
So, after 3 rounds, do we have a clear winner? Well, maybe the goal here isn't to crown one champion for everybody. The real goal is to help you choose the right champion for your portfolio and your goals.
The best way to think about it is like having a toolkit. For the core of your portfolio, for that broad, long-term, low-cost foundation, a passive ETF is an absolutely fantastic and reliable tool.
But if you're looking for a very specific niche strategy, or maybe you want to bet on a particular sector and you're okay paying more for the chance at outperformance, then maybe a carefully chosen active ETF is the specialized tool you need for that specific job. And that really brings us to what most experts suggest today. It's often called a core satellite strategy. You build the solid foundation, the core of your portfolio, with those cheap, diversified passive ETFs. Then, if you want, you can add a few smaller satellite positions in active funds to try and capture specific opportunities. You really get the best of both worlds, the reliable map for the main journey and maybe a guide for a few interesting side trips.
So, as we wrap this up, I'll leave you with one final question to think about. When you choose an investment, especially an active one, what are you actually paying for? Are you paying for guaranteed results, or are you just paying for the promise of them? Understanding that difference, well, that's the key to building a portfolio that's going to work for you. Thanks so much for tuning in.